let's talk about something that every single investor dreads, that pit in your stomach feeling when it seems like the entire market is in a free fall and you have to decide what to do.
I mean, it's the question, isn't it? You've done everything right. You saved your money, you invested it for the long term, and then bam, the headlines are all red. What on earth happens to your money, to your future? So you log in to check your portfolio and your heart just sinks. It's down 20%. All those gains you watched build up, it feels like they've just vanished. That anxiety starts to creep in, right?
But then it keeps going. Now you're looking at a 30% drop. The news is just full of panic. Everyone's talking about a recession, and that little voice in your head gets louder and louder, saying, just sell, get out now before it gets worse. And what if it hits 50%? I mean, half of your portfolio gone. This is where our own psychology works against us. There's this thing called loss aversion. Basically, the pain of losing money feels twice as bad as the joy of making it. And right there, in that moment of pure panic, that's where the biggest mistakes are made. Okay, so before we get into the strategy, just a quick but important heads up. This is all for educational purposes. It is not financial advice. So please always chat with a professional about your own situation. All right, so to really get a handle on the fear, we have to understand what we're actually dealing with. Let's pull back the emotion for a second and just look at what a market crash really is. At its core, a market crash is just a very fast, very steep drop in stock prices. It feels like pure chaos, but it's usually triggered by big events. Things like a financial crisis or a global event that shakes everyone's confidence. And here is probably the most important thing to burn into your memory when this happens. We have been here before, many, many times. The market has a long and, let's be honest, an uncomfortable history of doing this. I mean, just look at the recent past. Remember the dot-com bubble bursting back in the early 2000s? Or the huge financial crisis in 2008 that shook the whole world? Or even that really sharp, sudden drop we saw in the early 2020s? Each one of those felt like the absolute end of the world at the time. But, and this is the part you cannot forget, look at what happened after every single one of them. The market didn't just crawl back, it recovered, and then it soared to new all-time highs. This isn't just wishful thinking, it is a historical fact. The pattern is always there, a crash, a recovery, and then new growth. So if we know that recovery is the historical pattern, why do so many people end up losing money? Well, it all comes down to one single emotional mistake. Think about it like this. You have two investors. The panicked investor lets that fear take over. They see the markets dropping, they sell everything near the bottom, and they turn what was a temporary on-paper loss into a very real permanent loss. But then you have the disciplined investor. They feel the exact same fear, but they don't act on it. They just stay put. They ride it out, and their portfolio recovers right along with the market. Okay, so how do you make sure that you are that disciplined investor? Well, you need a plan before the crisis hits. A simple playbook to follow when your emotions are screaming at you to do the exact wrong thing. So here's that playbook. It's actually pretty simple. Rule number 1, and this is the big one, do not panic sell. Just resist that urge. Number 2, if you have a job and you're still investing regularly, keep doing it. In fact, you should get excited. Think about it. The entire stock market is on sale. The same money that bought you 1 share a few months ago might now buy you 1.5 or even 2. And number 3, zoom out. Remember your long-term plan. You're not investing for next week. You're investing for goals that are years, maybe even decades down the road. This crash, it's just a bump on that long road. Now, it's really important to say that your exact strategy does depend on where you are in life. This isn't a one-size-fits-all kind of deal. So if you're in what we call the accumulation phase, you're still working, you're saving, a crash is, believe it or not, a huge opportunity. You get to buy quality assets at a deep discount, which can seriously boost your returns later. But if you're already in retirement and you're living off of your investments, the game is different. Caution is everything. That's why having safer things like bonds and a cash emergency fund is so important. It lets you pay your bills without having to sell your stocks when they're down. So when we look at all the data, all the history, all the strategy, it really all boils down to one simple, powerful idea. And here it is. Your long-term success as an investor has almost nothing to do with the crash itself. The market's going to do what the market's going to do. Your success is determined entirely by how you react to it. It's not a test of intelligence. It's a test of your temperament. I want to leave you with this one thought. Try to stop thinking of a market crash as some kind of catastrophic end. It's not. It's just part of the journey. Yeah, they're scary, they're uncomfortable, but they are a normal, expected part of building wealth over the long run. And the person who truly understands that, well, that's the person who wins.